Index funds versus ETFs. This is one of the most common questions that I get, so I wanted to make a comprehensive video going through the differences between index funds and ETFs.
Relax and take notes.
The four main differences that I see are trading, fees, choice, and minimums and accessibility, which I'll go into more detail in a second. And there's a few more complicated differences which I'll get into towards the end of the video. But the first thing I wanted to say is they are both great ways to invest for the long term. Both index funds and ETFs are a diversified basket of stocks that are low cost or low fee, that are passive, that are hands off. That are both great ways to invest monthly and to invest for the long term in the stock market.
Best thing since sliced bread.
But obviously there are different ways to invest, so there are a few differences and I'll run through them now. To get straight into it, the first difference is trading. An ETF trades like a stock. What that means is when the market is open, an ETF's price will fluctuate second by second up and down, just like an individual stock does, like Apple or Microsoft. The same is true of ETFs. When the market is open, the price will be fluctuating up and down. On the other hand, index funds are only valued once a day, and that's at the end of the day. Now, this is one reason why I prefer index funds over ETFs, because when you're investing for the long term, you don't want to get dragged into checking the price daily or watching every single movement. You almost just want to set it and forget it. So if you do use ETFs, just make sure you're not trying to trade ETFs. And this is sort of one of the downsides of ETFs being introduced. The reason why they were introduced is to essentially fit the gap in the market between index funds and day trading. So they created the ETF where you can now essentially day trade index funds. I mean, you think it's hard enough trading one stock like Apple. Imagine trying to trade the S&P 500 ETF where there's 500 companies. It's essentially just gambling. It's very difficult to do. So if you do use ETFs, just make sure you are using them to invest into monthly or weekly for the long term and you're not attempting to day trade them. The second difference is fees. This is probably quite an obvious and brief point, but it goes without saying that not all index funds and ETFs are created equally. Personally, I use Vanguard for the different ETFs and index funds that I invest into, just because I trust them and they're usually the lowest fee or one of the lowest fee options, but not all index funds and ETFs have the same fee. For example, I'll leave this link in the description, but there's a good website called Just ETF where you can see the different fees of different index funds and ETFs. So I've got up here top S&P 500 ETFs, and the fees range from 0.05% to 0.15%. So even though they're both fairly low fee, that's a 3 times, the 0.15% is 3 times the lowest option. And if you then compound that over the long term by simply choosing a lower fee ETF, in this case a lower fee S&P 500 ETF, you can literally save yourself thousands, if not tens of thousands of pounds over the long term. So it's important you know exactly what fee you are paying, whether it's an index fund and an ETF, and if there's a cheaper option, then it's usually better to go with the lowest option. Another bit that I quickly wanted to add on this point here, sorry for the random clip, is that there is no difference between an S&P 500 index fund and an S&P 500 ETF. They will both invest into the S&P 500, and once again it comes back to a key difference here being the fees. If the S&P 500 index fund is a lower fee than the S&P 500 ETF, then it would make sense to go with the index fund because you want to keep your fees low, and they're essentially the same product, so the lower fee wins. The third difference is choice, and this sort of comes back to the very, very basics of what an index fund is and what an ETF is. So an index fund simply tracks an index. The FTSE 100 is the largest 100 companies in the UK. The S&P 500 is the largest 500 companies in the US. You've also got all world or all cap, where you can essentially track the global stock market index. On the other hand, an ETF can really be anything. So you can get ETFs that are also FTSE 100, that are also S&P 500, that are also tracking the whole world, but you can also get specific ETFs for certain sectors like electric vehicles, cloud computing, technology, and so on. That's just something to be aware of. With index funds, you're just tracking an index, whereas ETFs, you can also just track an index, but they're becoming increasingly more niche and specific to fit gaps in the market and once again fit consumer needs. In my opinion, you don't really need, there's too many ETFs, it's choice overload. People end up investing in loads of different ETFs which all overlap each other, and you can pretty much get all of the diversification that you need from one global index fund or ETF. But on the other hand, if you do want to invest into a specific industry like electric vehicles, if you believe in that in the long term, then you can do that through ETFs. Just once again, going back to the first point, make sure you don't trade ETFs and that you are just buying and holding for the long term, because they are very difficult to trade. Day trading individual stocks is hard enough, as I already mentioned, let alone ETFs.
Relax and take notes.
The fourth and final basic difference is minimum investments and accessibility. So generally speaking, with index funds, you will need more money to get started. So I know from my accounts with Vanguard and Hargreaves Lansdown, if you want to make a one-off investment into an index fund, you need to invest at least £100. And I think if you want to set up a monthly investment, it needs to be at least £50. It's not a huge amount, but I know on Trading 212, for example, if you want to start investing into an S&P 500 ETF, you can start with £20 and you can do that as frequently or infrequently as you like. So it's a lower minimum money required, which therefore makes ETFs more accessible. So not only are ETFs more accessible in the sense that you need less money to get started, but they're also, generally speaking, available on more platforms. For example, on zero commission brokers like Trading 212 and Free Trade, they have a whole range of different ETFs that you can invest into. Generally speaking, ETFs are available on more platforms. So they are the four key differences. ETFs trade like a stock, whereas index funds are valued once a day. Fees, make sure you check the fees out. Not all ETFs and index funds are created equally. Free is choice. ETF, there's a lot more choice. If anything, there's actually choice overload, which is why I prefer index funds, but you can fit specific needs or niches if you want to invest into them. And then 4, minimums and accessibility. ETFs generally require lower minimums and are also available on more platforms. So now to get into a couple of the more complex differences. These are things that you don't really need to know, but I know this is making money simple, so I don't want to overcomplicate it, but at the same time, I thought I would just mention them briefly, just so you're aware of them. The first one is the bid-ask spread. So the bid-ask spread means that when you buy a stock, you are automatically in the red because the price that you can buy at is higher than the price that you can sell it at immediately in the same second, which is why you always start a tiny bit in the red as soon as you've bought something. The danger here is if you're trading an ETF that is very small and very illiquid, meaning there's not much trading of it throughout the day, there can be very large bid-ask spreads. Of course, if you're investing in the VUSA, which is the S&P 500 ETF, that's traded very widely, so it's very liquid, so the bid-ask spreads will be very small. If you are trading more niche, smaller ETFs, just be aware of the bid-ask spread because you could start as much as 1% down, and that's a fee essentially. You're paying a 1% fee just to buy, and then the danger there is if you're buying quite regularly every week, you're essentially being charged a very high fee and you're being penalised for buying an illiquid small ETF. Once again, you probably don't need to know that. If you're buying, the S&P 500 or a global ETF, then that's not going to affect you because they're widely traded, but I just wanted to mention it so you're aware of it. You know what? I'm actually going to leave it there. There are a couple of more quite complex differences. I'll leave a link to a Motivator article in the description, which I just found if you want to read more, but I've covered here pretty much the bulk and the main key differences between index funds and ETFs. If I had to pick one, in my opinion, I pick index funds. Index funds have been around since 1975 when Jack Bogle, the founder of Vanguard, created the very first one. Because they're only valued once a day and also orders are only executed once a day usually, you're not going to get sucked into buying and selling and checking the price on a daily basis, so you can take your emotion, your human emotion, out of investing. The things with ETFs is there's always new ones being created to fit different niches and different needs, and personally I would rather just buy a global index fund every single month, set it and forget it, very automated, very passive, very hands-off, and that's exactly what I'm looking for over the long term. But yeah, so that wraps up this video. That is the differences between index funds and ETFs. If you have any questions, let me know in the comments and I'll get back to you. But as always, thank you very much for watching this video.